Neobanks acquire customers for 1/10 your cost. Still think your brand protects you? While you're spending $1,200 to onboard each new checking account, digital-first competitors are doing it for under $120. And they're not just cheaper, they're faster, more convenient, and your customers are choosing them right now. The cost gap isn't a future problem. It's bleeding your growth today. Here's what most bank executives miss. You see the marketing budget. You see the branch overhead. You see the technology spend. But the real cost sits in the invisible friction built into every process your legacy infrastructure creates. Every manual step in account opening, every callback to verify information, every delay while systems sync overnight instead of in real time. Each friction point costs you money and costs you customers who won't wait. We work with institutions running on Fiserv, Jack Henry, and FIS. The big three core providers serving over 70% of U.S. banks. These are solid, proven systems. But here's the reality. They were architected in an era when customers came to you, when opening an account meant a branch visit and a 30-minute conversation, when 3-day processing was standard because everyone processed in 3 days. That world is gone. Your customers now compare you to experiences that happen in seconds. And when your cost per account is 10 times higher than a neobank's, that gap shows up everywhere. Slower approvals, more requirements, more friction, more reasons for customers to choose someone else. The institutions winning right now understand something critical. This isn't about technology for technology's sake. It's about economics. When your competitor can acquire and serve a customer for a fraction of your cost, they can offer better rates, lower fees, and faster service, while still making money. You're not just competing on customer experience anymore. You're competing on unit economics. And if your cost structure is 10 times higher, you're fighting with one hand tied behind your back. Let me tell you about a regional bank we worked with 18 months ago. $300 million in assets. Strong community reputation. Profitable, but their growth had stalled. They were spending heavily on marketing, running campaigns, investing in brand awareness. And customers were coming in, then dropping off during account opening. Their cost per acquired checking account had climbed to $1,400. Meanwhile, they were watching deposits flow to digital competitors they'd never heard of 5 years ago. Patricia Hammond, their chief operating officer, sat in a quarterly review meeting, adjusting her reading glasses, looking at the numbers. She turned to their team and asked the question that changed everything. Where exactly does that $1,400 go? What they discovered wasn't a single problem. It was 37 different friction points between a customer saying yes and an account going live. Applications that required branch visits, identity verification that took 3 business days, systems that couldn't talk to each other without overnight batch processing, manual reviews that created bottlenecks. Each step added cost. Each delay lost customers. They brought in Marcus Chen, an AI strategist, who'd helped other institutions navigate exactly this challenge. He pulled up analytics on his tablet showing their customer journey mapped against digital-first competitors. You're not losing on brand, he told Patricia. You're losing on process. Every step that takes you hours takes them seconds. Every step that requires human intervention costs you money they're not spending. This isn't a technology problem you can solve with a vendor. It's an architecture problem that requires rethinking how your systems work together. The moment Patricia understood the real issue was when Marcus showed her something specific. One of their competitors, a neobank that launched 3 years ago, was running their entire customer acquisition and account opening process through APIs that connected everything in real time. Identity verification, credit checks, account creation, card provisioning, all automated, all instant, all integrated. Their cost per account? $115. Not because they spent less on technology, because their technology eliminated the manual work, the delays, the handoffs that consumed resources. Patricia made the decision to act, not to rip and replace their core system. They were on Jack Henry. And the core itself wasn't the problem. The problem was everything around it. They focused on 3 areas. First, API-enabled integration layers that let modern applications talk to their core in real time instead of batch. Second, automated identity verification and compliance checks. That happened instantly instead of taking days. Third, digital account opening workflows that eliminated every unnecessary step and manual touchpoint. The transformation took 9 months. When they measured the results, the numbers were undeniable. Cost per acquired checking account dropped from $1,400 to $380. Account opening time went from an average of 4 days to 11 minutes. Customer drop-off during onboarding fell by 62%. But here's what mattered most. For the first time in 3 years, they were growing deposits faster than their digital competitors in their market. Not because they became a neobank, because they fixed the economics. Marcus reviewed the analytics with Patricia 6 months after go live. "You're still not at their cost structure," he said, pulling up comparative data. "But you don't need to be. You have advantages they don't. Local relationships, trust, branch access when customers want it. You just needed to stop paying 10 times more for the basics." Patricia adjusted her glasses and smiled. "The question isn't whether we can compete with neobanks. The question is what else we're overpaying for." That's the insight most institutions miss. This isn't one problem. Your cost structure has inefficiencies everywhere. Account opening is just the most visible one. But loan origination, payment processing, customer service, account maintenance, every area where you're relying on manual processes and disconnected systems is costing you multiples of what it should. So here's what you do this week. Run one audit. Take your most common customer journey, whether it's opening a checking account, applying for a loan, or setting up digital payments. Map every single step from customer request to completion. Count how many systems are touched, how many manual handoffs occur, how long each stage takes. Then ask your team one question: where are we paying for friction instead of value? You don't need a transformation roadmap yet. You need to see where your money is actually going. Because here's what we know from working with institutions across the country. The banks that win over the next 5 years won't necessarily have the newest technology. They'll have the most efficient operations. And efficiency isn't about spending less. It's about eliminating the costs that don't create value, so you can invest in the things that do. The cost of waiting is higher than you think. The next video proves it.